Afternoon, everybody. Episode 22, Taking Stock After the Bell. Delighted to be joined, as always, by James Hughes, investment manager, colleague. He's recovered from his minor head injury. And we're absolutely delighted to be joined by Freddie Lait. Freddie, good afternoon. Freddie is the managing partner at Latitude Investment Management and the portfolio manager on the Horizon and Global funds. Before founding Latitude, he was a fund manager at OD Asset Management. Prior to this, Freddie spent 2 years at Rothschilds as a fund manager and a member of the investment committee, no less. Initially worked at Goldman Sachs Asset Management. We were recently on the road at Goldman's podcast there.
First away trip,
where he was an analyst focusing on US equities and long-term asset allocation modelling. Freddie holds an MA in Maths from Oxford and is a CFA charter holder. Delighted for you to join us.
Very good to be here.
So you didn't work very hard at school at all, did you?
Still working hard. I'm doing something wrong.
Yeah, quite.
I think probably where we wanted to kick off, Freddie, one of the themes on the podcast has been changing the world. We'll come on to that though. But I think this story about the Magnificent Seven and US equities powering everything else, and where you sit in terms of, obviously, it's been a very good year for the biggest stocks in the world in the US market. They now make up 17% of the global equity market, and they are up collectively about 100% probably. So if you didn't own them this year, it's probably not looking too clever for you, despite the last month, which has been a lot better actually. It's been comforting. So I mean, where do you sort of stand in terms of how you see those businesses and their prospects going forward? It's a nice straightforward question for you.
Yeah, I mean, look, they are slightly different businesses, the Magnificent Seven, these big technology shares, and they're basically great businesses. They have strong market positions, strong competitive advantages, are growing nicely, have structural as well as cyclical growth. Most of them are quite cyclical, which I think people underestimate their cyclicality, but they're strong, entrenched businesses in our world. You can't imagine we're going to stop using Netflix or stop using Google or stop using Apple or stop using Microsoft products. So they're great businesses, but I think it's highly unimaginative if they're the only seven you can find in the world that are growing, have demonstrable competitive advantages, and have room to grow over the next 10 to 20 years as well. And that's what we see as the problem here, that because they're so popular, they're pretty expensive, and some of them the highest they've ever been in terms of valuation compared to history, at a time when they're already very large. And there is some cyclicality in the businesses which could come to pass if we hit a recession in the next, or whenever we do, in the next year or two. So they're priced slightly for perfection, and they've got a bit of a premium as this kind of like a rare whiskey or something that's not quite worth it, but it's there because it's rare. People are putting a too high a valuation multiple on these stocks because there's only a few of them. And we would basically just say it's highly unimaginative.
Is that because the rest of the market, is it a sort of defensive trade to buy the Magnificent Seven, in the sense that the rest of the market looks okay-ish, but not great, and maybe we're going to get a recession, and therefore we want to be hiding in Microsoft, which is probably going to grow at 10% if you have a recession or not? Is there an element to that?
Absolutely. I mean, I've heard them hawked as the defensive trade because of that. They will grow probably, and I probably have sympathy with that. They probably will grow. I've seen it obviously as the only source of growth being AI for the next few years. Everyone wanting exposure to the artificial intelligence boom. So that sort of hype cycle, it's the best way to play it is the incumbents at the moment, because all of the disruptors are still private. They're multi-billion-dollar businesses, but they are private at the moment, so you can't invest in them. So yeah, they have all sorts of sort of reasons to own them. And I'm not anti. We own Alphabet, Google's holding company. So we are still invested in one. We've owned most of them in the past, and we just have this model in our portfolio where, if a stock's gone up too much and we see it as too expensive for the growth we expect, and we're quite bullish on all these companies. If we think it's too expensive for the growth we expect, and we've got something else which we think is competitively advantaged and has 10, 20 years growth, that's more interesting and lower risk for our clients. And I think that's what's been ignored in the last year or two. There's a lot of other businesses that are growing and improving their business positions very substantially, demonstrably, and aren't being rewarded for it at the moment. But over time, they always are, because over time, the price of a stock always follows the underlying earnings and cash flow.
Glad you mentioned that. We've got a chart on just that, which you kindly sent to us. So the blue bars here on this chart show earnings per share since 1954. Is this S&P 500? Is it US market data? And then in orange overlaid is the price performance of those shares. And we can see that over the long term, they pretty much match,
Absolutely.
meaning that the performance of a share is pretty much down to the performance of its earnings and its underlying business. How do you think about this in terms of? I mean, there are a few periods here where the lines do diverge. So one interesting bit to this is the 60s and early 70s, where price performance probably outdid earnings growth, and again to a degree in the late 90s. Sort of nifty 50 is something that we've referenced in the past in the 60s and 70s, where you had the IBMs and the Coca-Colas and the Eastman Kodaks trading on kind of silly multiples. Do you think that there's a fair comp there, bringing it back to the Magnificent Seven?
Absolutely. I mean, I think, you can look at this chart and say, okay, that's easy. We just need to buy businesses that are going to grow their earnings and will have the same performance. But as you can tell, if you eyeball the chart, if you can see it, there were really flat decades. A flat decade from mid-60s to mid-70s, a flat decade from the noughties to 2012. And so, we have these periods where you don't actually get rewarded for the underlying growth. And you have to be a very patient investor, which is something we believe in wholeheartedly. Obviously, the week that Charlie Munger died, the source of font of all wisdom on being patient and thinking behaviorally, intelligently and rationally about the market. This is true, and this will be true over the next 30 years, that if you have a portfolio or a stock whose earnings per share grow at about 10 to 12%, your price performance will be about 10 to 12%. And if you are paying a very low multiple today, it may be slightly better than that. If you're paying a very high multiple today, it may be slightly worse. This is true for cash flow as well, and cash earnings are sort of comparable. But the difference in return structures in a forward-looking basis all pretty much comes down to valuation. If the market starts at a cyclically high point, like it did in 65 or like it did in 2000, you are most likely in for a very, very weak decade of returns. And if it starts at a cyclically low point, like it did in 82 or it did in 2003, you are likely in for a 10 or 20 year period of stronger returns. And so, we have obviously the Magnificent Seven today, which I would have some exposure. There's nothing wrong with having a little bit of exposure. We have one of those stocks, but I wouldn't be, put 50% of my portfolio into that. There is another ill-defined sort of nifty 50 today as well, the same stocks that make up most people's top 10. And again, they are great businesses. The nifty 50 were in general great businesses.
Yeah.
But
most of them survived as well.
And most of them survived, and some of them thrived.
Yeah.
But what you saw was that those businesses, and these were across a wider spectrum of sectors than just technology like we have in the Mag 7, and this is true today, they did outgrow the market. For the next 10 years, they outgrew the market by about 3 or 4% a year. So the businesses did better than the average business by 3 or 4% a year. Yet the performance of them as a basket was 3 or 4% worse than the market. And that wasn't some shocking crash. And we're not here sitting to tell you that there may or may not be a crash. Who knows about that? Yeah. But your return will be eroded somewhat if you overpay when you start investing. And that's the biggest risk with some of these stocks.
Yeah, I totally agree with that. And kind of on that theme, here's the couple of, we're long past Halloween, but here are a couple of Halloween charts that you sent us. So there's a model here in orange of the implied forward returns on the S&P 500 going back to December 1965 and the actual S&P 500 price. And if we kind of zoom in on the present, it looks very much like the S&P 500 is trading quite a long way above the implied price, suggesting that the market is a little bit overvalued.
Yeah.
Do you want to talk us through this?
Yeah, sure. If you wouldn't mind jumping one slide ahead, what we've shown on this one is something called the cyclically adjusted PE ratio. It's put together by an academic called Schiller. And what it's doing is it's really showing you how expensive the market is compared to the average of the last 10 years of earnings. So, where in the cycle of valuations are we? And it's inverted on this chart. So if it's at the bottom of the chart, that's the most expensive. And you can see the dot-com bubble really standing out there. Yeah. And then you can also see 1982, I assume, looking quite inexpensive. And so what this is, and then the blue line is the 10-year forward return from the S&P 500. So what it generated over 10 years, and the axis may be a bit slight, but it's on the right-hand side, this number. So if the blue line is showing you that today, the annualized return for the last 10 years has been about 10%. That's where it is. But what the valuation today is telling you is that the return for the next decade is likely to be closer to 2 to 3%. And so if we go back to the previous chart, you can build an implied forward channel. So that orange line creates this orange line. And it tells you where the valuation will imply the market's fair value is in 10 years' time. And so you can see it correctly anticipated that flat market in 1965-75, correctly predicted it 2000-2012. And we believe it's got good reason to be followed with some intent. I mean, it's not some kind of voodoo. It's not going to be bang on accurate, but it seems highly likely that you're swimming against the tide buying S&P 500 shares today. And that given that they're, as you say, 17% of the world market, that would imply 30% of the US market, these 7 stocks, and they are expensive compared to history. They are one of the main culprits as to why this is true. So again, it's not saying we know why they may struggle or that they definitely will. It's that the risk they may keeps us away from them.
And this is obviously market cap weighted.
That's market cap weighted.
Would it look quite different if we did an equal weighted S&P?
So on a spot basis, the equal weighted S&P is probably 2 multiple points cheaper.
Yep. Okay.
2.5 multiple points cheaper now, something like that.
So does that bring it into range?
It would help it a bit. Yeah, it would probably move the, well, let's think about it. If it was 3, it would be 20%. It would probably take it up another 2% annualized. So instead of being a 3% forward return, it might be closer to 5.
Okay. Yeah.
I mean, I guess my kind of pushback on that is that comparing businesses in 2023 to businesses in 1970 or 1980 is not always representative, in the sense that, you know, a lot of the things that we talked about, that Charlie Munger and Buffett talk about, moats and margins and, you know, the different types of businesses. You know, we're not all banks and metal bashers and steel companies and railroad companies in the same way that we were in the 60s and 70s. And therefore, you know, valuations have got structurally higher over time for some potential good reasons. I mean, admittedly within a range. And a sort of chart that I pulled out that I wanted to kind of show was how US companies are structurally more profitable here. So if we take a look at the chart here, we've got return on equity, which is essentially, I mean, both charts essentially are margins on the bottom pane show how profitable companies are, essentially. And US companies are broadly more profitable, both versus the rest of the world, and than they have been 10, 15, 20 years ago. I mean, is that sort of fair way of thinking about it in terms of explaining some of that valuation?
So there's 2 things in there. There's the margin structure, and there's also the quality of the business. And I think the thing to remember is that every single year in the 100 years of history we're showing, the businesses were seen as innovative, cutting edge, forefront, stable. How could Standard Oil ever end? How could, Exxon, how can these businesses ever end? How can Nokia ever lose its dominance in phones? How can Eastman Kodak ever die? How can Apple and Coca-Cola and all the other staples of those days that were, Coca-Cola was growing at 25-30% a year at that point. It was dominating the world. Brands were eating the world. So it's been true that at any given time, if you read the Forbes articles, it would be talking about these businesses, our modern businesses, are undisruptible. And yet capitalism has a way of always struggling, causing successful businesses to struggle, which is a good thing. But it's a challenging thing from a stock market investor's perspective. So there have always been reasons. I think the dot-com bubble is an unfair example because that was a bit of a mania because there wasn't really fundamentals to back it up. But I'm not so convinced about necessarily the sort of quality of business being demonstrably better than it has been in the past. On the margin point, it is true, and this is a sort of 20-year chart, and this is a 100-year chart showing you the margin progression. And margins are really quite near their highs. And so if you believe they're going to stay there, and therefore the return on capital will probably be higher because return on capital, if you break it down, is dependent on the margin, then they can generate faster growth in the future. They reinvest at higher rates of return and they can make more money. So the big question is in your confidence in them staying at this level. So if they do, I would argue you're right. They do justify a higher valuation. Sorry, not you're right, but your sort of your premise is correct. I believe these are not going to stay here. I believe margins are set to fall over the next decade, and I think there's a sort of empirical sort of reason, which is if you just look back over history, and again through nearly 100 years of innovation and challenge and technology and productivity improvement, and then war and famine and chaos and everything else, there was a reasonably mean reverting series. And then you saw one major change in 2000, around 2000, which was when China entered the WTO, creating a whole new source of revenue selling to China, and also much, much lower cost inflation than you should have had from offshore labor and offshore manufacturing and offshore production.
Yeah.
So you widened your margins substantially through that period. It was interrupted by the financial crisis, but then it had been falling already and mean reverting from 2010, which was when global trade as a percentage of GDP peaked. It's been falling since then. And then we've just seen this sugar rush of 200 basis points post-COVID, when the government just printed money and gave it to everybody. And that led to much faster revenue growth than you saw cost growth. But now what we're seeing, especially from a bottom-up perspective, is much more cost inflation seeping through. So to get into the present, wage inflation, commodity price inflation, increased taxes, increased depreciation costs as you have to replace your capital stock at a higher price, higher interest costs. Those are all margin dilutive. And I can't really see the justification for higher margins. So in terms of symmetric risk from here, I think it's highly skewed to the downside. Then you just have to attach a probability in where you think it may get to. So we're nervous about the level of margins that companies are earning in aggregate.
I guess, a kind of a bearish thesis for next year would be that the S&P is currently forecast to grow earnings at 10% in 2024. But if if inflation is lower, if you think about it, if you think about a company, sales growth generally runs at the rate of nominal GDP in the aggregate, so inflation plus real GDP.
Yep.
Well, if inflation's coming down, nominal GDP growth is coming down, so sales growth can't be as high as it's been in, say, 2021 and 2022.
Absolutely.
And you've got the lagged impact of rising costs because you can't keep your labour costs down forever. You have to pay a bit of interest on your debt now because interest rates are now 5%.
Exactly.
And depreciation charge is higher. That's quite an interesting sort of anecdote. I saw my father yesterday, and he's a farmer, and machinery replacement is quite a big part of our business because you have to buy very expensive combines. But if your combine was £250,000 5 years ago, you're now coming up to change it, it's now 350.
Exactly.
Ooh, that's quite a big hit on the depreciation going up.
Hits your depreciation and really hits your cash flow.
And
Because you only get that cash back over the next 5 years.
And of course you've now got to pay a lot more to finance it as well.
Exactly.
So there is quite an interesting thing. Maybe that sugar rush of the last 2 years in terms of corporate profits, maybe that does unwind, and maybe the bear case for next year is that the 10% earnings growth figure that is still pretty much in consensus is optimistic.
I don't know if you've seen one of those wonderful charts of earnings forecasts at the beginning of the year for the S&P, but it's 10 to 11% every single year. And then we just figure out where we get to. But I mean, this chart might be more helpful to go to your chart, actually, the one you put together on margins, just to sort of see. So, from the kind of level before...
This is the last 12 months. So the top one is
ROE.
ROE.
That's ROE. So from here to here, I mean, it's already coming down, is the point.
Yeah.
You are seeing it start to come down. And if that falls another 100 basis points, margins are 11, 10 in the US. That's 10% off earnings. That's the whole estimated growth rate for next year done if it just comes down a little bit. And so, the way we look at things is always a sort of balance of probabilities, and trying to get luck in your favor is a big part of investing because no one ever knows. We believe starting at high valuations puts luck out of your favor. You are more likely to struggle over time, especially over longer periods of time. And I would take the same on the margin point. I think if you own a business that has expanded margins aggressively in the last 5 or 10 years, which has been very easy to do in a low interest rate, low economic volatility environment. It's been a very easy environment to make money as a business and to make money as an investor. Basically, we feel that's changing with economic volatility, geopolitical volatility, capex cycles returning, earnings volatility likely returning, crazy government policies, and all the rest of the stuff we've had forever.
And we've sort of got a bit of and it's not really a chart at all. It's something which you also put in, which I thought, and again, it's been a theme of the pod about how the world might be changing from what we've seen in the last 10, 15, 20 years of low inflation, falling interest rates, easy money, globalization, to does that reverse? Do we get deglobalization? You've got reshoring of manufacturing to the US. You've got, as it shows here, US-China potential trade war, albeit Xi Jinping was shaking a few hands in California last week, so he's trying to, assuage those concerns. We've got the Middle East.
California.
Yeah, we've got the Middle East. We've got energy transition, which is going to take a huge amount of capex, and we've got some splintering in geopolitics, haven't we? So does that sort of suggest that the next 10 years, I mean, are we right to think about the next 10 years being very different to the last 15, 20?
I wholly believe so. Yeah, I think we are out of that era of zero interest rates. We're out of that era of buy the dip and it always carries on going up into an ever higher multiple. And businesses themselves are going to find life a little bit harder. It doesn't have to be shockingly difficult. Again, this doesn't have to be some major market crash. A lot of people think, because the most recent echo is the financial crisis, that there's going to be some sort of
PTSD about it, haven't we?
Exactly.
Yeah.
I don't think that's true at all. I think there's banking systems in Europe and US, main developed market banking systems, are far more robust than they were even pre-financial crisis. But
you've also
certainly
seen how
during.
regulators have acted with the mini banking crisis.
Exactly.
And, if they'd acted that quickly in the GFC, there wouldn't have been a GFC. So
Yeah.
I think there is more protection out there for us, which is is no bad thing.
I think it's highly unlikely we see a financial crisis anything like to the degree. We'll see pockets of credit defaults and things like that, but that is what you ought to see in any business cycle. So that shouldn't be scary in itself, and we don't have to extrapolate it to be some negative spiral downwards. And I think, as you say, the banking sector and the regulators are kind of in a position where they're willing and able to support that not being some cascading event. But just, imagine a world where, as you say, inflation's coming down. Maybe it does bob around 0 to 2. And underlying growth, real growth, is pretty anemic. Revenue growth for most businesses will therefore be about 0. And margins will be getting a little bit squeezed because you're still paying people, you're still having the volatility. Demand is sort of softening and falling. That's a really tricky environment to make money. And then you'll have periodic shocks from supply chains or deglobalization or rebuilding capex or whatever else it might be. It just feels like a very difficult world as we see it. And yet the market at the moment is pricing in a world of basically soft landing, sublime disinflation, lower economic volatility. And I think I take the other side of that.
So do you think, kind of when you think about structuring your portfolio, a lot of managers out there that have been running money for, say, only 10 years, it's all been about revenue expansion and growth and growth and growth.
Yeah.
But where do you sort of start from with, you've obviously got, the portfolio is constructed, but where do you see the opportunities? What sort of companies are interesting to you and the types of businesses that can navigate, the landscape you've just spoken about?
Yeah. I mean, the two primary things I think people should focus on right now. Well, look, as we showed in the very early chart, you need to own growing businesses if you're going to deliver a performance for your clients. So if you're going to own something for 10 years, you can't think it's going to go from 12 to 15 times and that's your story. You've got to believe in underlying growth. So all of our businesses, we believe, will grow and grow durably and knowably for the reasons we have, which are protected by competitive advantages. Now, those exist in industrial, healthcare, energy, utilities, retail, consumer. They exist everywhere. And, someone like Jamie Dimon, I think, runs a business that is highly competitive advantaged in JP Morgan. That's a bank. There's only very, very few banks in the world that are very good. There is one. Michael O'Leary runs a fantastic business in Ryanair in a very difficult industry.
Yeah, both those banking sector and the airline sector historically have not been very kind to shareholders.
No.
I think a lot of managers have said they're uninvestable sectors. And these are two managers that have completely nailed it in basic terms.
Yeah, and compounded returns at sort of 13, 14, 15% a year for 20 years through crisis and are still trading at reasonable valuations. So those are sorts of businesses where I think it can be interesting. They're cyclical examples. But in general, you need two things, according to the way I see the world in the macro slides we've just gone through. You need a margin of safety. People think 22 times is inexpensive because that's what we've been conditioned to think. It's pretty expensive. It's 50% more than average. So you could fall quite substantially at some point, either quickly or slowly. That can be a real drag on your return. So margin of safety. And then the second one, rather naffly, safety of margin. You need to believe that your specific analysis on the company supports them maintaining or growing their margin. You can't lazily assume that margins are just going to float higher, which is something we've been able to do as analysts over the last 10 years. Oh yeah, they'll grow a bit and they'll add a bit of operating leverage, so their margin will expand. Well, if the base case is that the whole market's margin's doing this, you've got to have a real reason, a genuine bottom-up reason for why you think you can support yours. And so I mean, that can be very varied sectors. I mean, there's a business called AutoZone who just reported this afternoon. They're an auto parts company. They're growing very strongly, 12% a year revenue growth for the last 4 years, 20% earnings growth over the last 10 years, faster than almost all of the Magnificent Seven. Trades at 16 times earnings, highly competitively advantaged in the US, no disruptive threat. Will continue, we believe, to grow 15 to 20% a year for the next 5 to 10 years. Again, similar to the Magnificent Seven. They sell car parts. And so there are other alternatives and equally successful businesses. And $1 of earnings and $1 of earnings growth is worth the same to an investor as long as it's durable, as long as it's got that competitive advantage. And that's the key thing.
And we've got 4 stock examples here, which we'll just flash up. 2 on the left that you do own, and 2 on the right that you don't own.
We don't own anymore.
So you own AutoZone and Alphabet, but you don't own Apple nor Microsoft. And this is these charts are sort of a mirror of the opening chart that we had around earnings versus price performance.
That's right.
And we can see AutoZone and Google's share prices remain connected to their earnings growth, whereas we can see quite clearly that Apple and Microsoft's share prices become somewhat disconnected from their earnings growth, i.e. their share price has grown a lot faster than their earnings, and hence the valuation multiple has expanded.
Exactly.
Do you find your opportunities are sort of cross-sector, and are there lots of areas that you can find stocks like these at the moment?
Yeah, I mean, I think we've got stocks from almost all sectors on our sort of list, our subs bench, if you like. That's how we build our model. Is we build up a list of sort of 70 or 80 stocks we'd love to own. We act like we own them all when we're visiting America or other countries we talked about earlier. We'll go and see all those businesses, not just the ones we own, and probably follow them for 2 to 10 years before we buy them. And so you just wait until you get that opportunity to buy into them. And you never know where the volatility is going to come in the market. People could suddenly start loving energy stocks again, and they can go up like they did 15 years ago. Mining and energy was what drove all client portfolios' returns.
We're very fond of the noughties commodities boom here.
Exactly.
This is how we started our careers.
Exactly. But, it was only 15 years ago. And so the concept that in the next 15 years we see another resources-led boom is not out of the question. And especially with the supply side dynamics in those industries really tightening, probably driving far higher prices. So you never know which way the fads in the market and the popular stocks will perform. And what we like to do is slowly, we only buy 1 or 2 stocks a year, slowly buy the ones that are out of favor, believing that over 10 years, price will follow earnings, and we can enjoy that and maybe a pickup in PE multiple as well. But we don't bake that in. I mean, another good example is Novo Nordisk, which has been the most phenomenal story. And we owned that for a few years and sold it about 9 months ago. And it's obviously carried on going up.
It's gone vertical.
But it was on 40 times earnings. And there was another business on our shelf, it was what we call our subs bench, called McKesson, which is a sort of drug distribution business in America. Equally sort of, nearly 100 years old, been growing at 15% a year for the last 25 years. Very solid, very strong growth business, very easy to understand, no competitive threats coming. It's trading on 13 times earnings. So the way we think about that, you can buy 3 times as much earnings today and then enjoy the growth in the future. So how much faster does Novo have to grow over the next 10 years to catch something that's got a 3 times head start? The numbers are pretty scary. And so again, we're bullish on Novo Nordisk, but we sold it because as a business, because we can do far better within our portfolio. I think that is what's being ignored a bit at the moment.
Is it being ignored or just misunderstood by the types of investors?
Well, I think there's an element to which people have written off certain sectors. So you say a lot of people say we don't do cyclical stocks, which I find quite amusing because I think Alphabet's a cyclical stock. But they say we don't do cyclical stocks, and we know what they mean by that. They don't do airlines, they don't do mining. They don't do certain other sectors. They don't like value investing, and so if something's cheap, it must be bad, rather than the idea that if something's cheap, it could just be cheap and brilliant. And this has worked so well for 10 years, and it's worked well for 10 years, phenomenally well for 3 or 4, that it feels very comforting to be reassured and to continue to own these stocks. So, and to reiterate, they're great businesses. You can feel consoled in that you do own some of the world's best businesses.
I think Microsoft is the world's best business. It is so dominant. There's no way that any company with more than 10 employees in the world cannot live without Microsoft. And dominance is becoming more entrenched because we're now also using the cloud on top of everything else that we use.
Yeah.
I mean, Excel runs the world in my view, but that's by the by. To come back to that comment about Alphabet, it is quite cyclical, you're right. And they do have sort of quasi-monopoly positions in certain areas, don't they? The search engine and online advertising. Any sort of concerns around that, or do you think that's just a great business and that's entrenched?
No, we still see a shift more and more. So, e-commerce is still, I don't know what it is nowadays, 15-20% of sales, less than that, probably going to 50 in the long term. I would have thought e-commerce will continue to grow rapidly. The way we think about that is as rent bills get shifted because you close physical store bases, the rent online is your advertising spend.
Right.
And so to get your search engine optimization and to get that, rent is about 10% of sales for global retailers. And so, as you move e-com on, you still probably grow the online advertising market as that kind of price to play on the internet. And Meta and Google have a duopoly in most areas of that. So no, I don't see a huge risk to it. I see continued growth. I see continued monetization of maps and YouTube and other assets. They have the third largest and now finally slightly profitable cloud business behind AWS and Azure. Supposedly, although it's very hard to get clarity on this, like actually better for certain functionality like AI rather than workhorse type jobs like AWS. So they have a lot of interesting businesses there. Google search and ads in general will continue to dominate the business for the next 5 years at least. But there are other avenues of growth too to support it.
Pretty cyclical, isn't it? That online ads. I know we saw it a bit last year. They did see quite a big drop off in spend last year.
Absolutely. And I think Microsoft actually, you'll be surprised, but there will be a squeeze in Microsoft.
Yeah,
in a down cycle
and that's interesting. I'm talk to Ben, our tech analyst, about that. He's got the data. Tech spending is GDP plus. It is cyclical. But the reason it hasn't been in the last 2 years is because we've all gone through COVID, hybrid working from home, and corporates have had to continue to spend money on digital transformation projects.
Totally.
But there might come a point where a corporate goes, well, actually, maybe that cloud transition plan that we've got in place, we might just kick it in the long grass for another year and push it out. Like maybe that kind of COVID haste of getting it done might just come to an end and more rational decision making takes place. But it'd be interesting to see. But you're right. You've got to stock Microsoft on 35 times earnings for 15 to 20% growth, 15% growth roughly. If that growth all of a sudden is 0 to 5, the multiple probably needs to be. I sit here and think, well, what should the best business in the world be trading on relative to the market? 2 times? Is that a bit too high? Probably 1.5 times, maybe. I don't know.
Maybe.
I don't know. Maybe.
I don't know. I mean, it's a good business because it's competitively advantaged and it's going to carry on growing, but it's already enormous as well.
It is.
I can't remember quite the stats, but if you believe, at 35 times, it's got to grow substantially to justify that multiple, in my opinion. Even if it grows at 15% a year, I think it ends up taking something like 18% of the profit pool in the US in 10 years' time. Doesn't seem likely. And that's assuming the profit pool grows at 7% a year, which it has over the last 100 years. So it's going to,
like that,
there is a limit for how big a business like that can become.
You mentioned retail, talking about online. Have you got anything in retail?
AutoZone is half a retailer, half a wholesaler. So yeah, there's a little bit there. We own Tesco's for your UK audience.
Yeah, that's very exciting.
So that's it's dull, but it's up 30% this year, and
I've just sold some actually.
Have you? Yeah. It's performing very well, and again, it's a story of the competitive dynamics that really drives the excitement. The story of Tesco's in a nutshell, which I know you know, but in case, is that 20 years ago, it was absolutely the Amazon of its day. It was on the front cover of Forbes. Warren Buffett was the biggest shareholder. It was compounding fantastic returns. It was then reinvesting those savings back in lower prices, building out its moat. No one could compete with them. They were selling everything. They had the data in Clubcard. And then in the mid-2000s, they started gouging on margin and just taking prices up and exploiting their market position a bit too much. The financial crisis hit. Aldi and Lidl were given oxygen to grow and got their footprint built out, and now they've been dominating because they have a much fairer value proposition. Then there was an accounting scandal as a result of all this poor hit business, and it took 5 or 10 years to fix that, as it always does. Turnarounds take a very long time. But Dave Lewis, the previous CEO, did fix that. And then since then, we've seen 2 of their competitors, Morrison and Asda,
blow themselves up.
Go to incredible lengths to blow themselves up in these extraordinarily leveraged private equity deals when interest rates are 1%.
Yeah.
And so the Asda bonds are trading at 80p in the pound. These businesses are not going to be willing or able to compete in a price war. They're not going to be innovative and investing to come and beat you next time. And Tesco's and Sainsbury's is equally interesting. I'd say,
Okay.
but Tesco's probably more so, given its scale, have lowered their pricing architecture substantially. Tesco's is basically in line with Aldi now.
Yes, it is.
And so you've started to see market share coming back after a decade of market share erosion.
We had Kantar this morning, didn't we?
Yes, we did. And it showed
Tesco.
Sainsbury's slightly ahead of Tesco, but they were both looking strong.
So 1.5. So yeah.
Pays a healthy dividend. It's trading on an 8.5% free cash flow yield. We think with the buyback and dividend, you can generate 15% a year from this stock. So if you're going to generate 15% a year from Microsoft, which you might, or 15% a year from this stock, which you might, this one's a third of the valuation, more defensive, equally dominant in its field, albeit a much less exciting field. But you know, you have to have a debate, and this is where the market's not having that debate. They're saying, well, Tesco's is an awful business, Microsoft's the best business. Well, okay, but is 3 times the price the right number?
Yeah, which just comes back to my point, isn't it? Like what is right? What is right?
And it's purely a relative value. It's something we say a lot internally, and when I'm giving talks, is there's no fair value for any asset in the world. It's all relative. You know, we've seen it. Cash now yields 5.
Gosh,
That's exciting. If cash yielded 20, how much would you pay for Microsoft? You don't have to answer it, but it's not 35 times earnings. And so it's all relative. It's relative to cash, it's relative to other opportunities, and it's relative intra-stock market. And I can see why you'd pay 50% more for Microsoft than Tesco. I get that. So maybe Tesco goes up to 18 times and Microsoft comes down to 24. That seems like a fair 5-year guess to me.
Yeah, that's fair.
And that's 30% downside for Microsoft on valuation, 35, 40, actually 50% upside for Tesco's on valuation, and they both grow 15% a year while you wait. That's kind of how we see it.
What about, you might say this is already in the price, which I probably think it is as well, but rates get cut next year, growth becomes more valuable. Do you think that's already there with Microsoft and Apple?
Yeah, I mean,
to go more expensive.
I had to write my fact sheet this morning. Do you know how many rate cuts are priced into America next year?
It's 4 or something, or 4.
I put 3 because I wrote it at the beginning of the month. It was 4 2 weeks ago. It's now 5.5.
I mean,
Alan said that this morning. Actually, morning
okay, so it's gone from 3 to 4 to 5 in the time we've been talking over the last month about this podcast. Okay, so you know that's why the Nasdaq was up 10% in November. Because it's there, and so the danger is
the likelihood of 5 cuts next year is.
I think.
You know,
who knows? But they'll only do it.
It's very silly trying to predict it, but
I think they'll only do it if there's a really weak economic environment, and if that's the case, stocks don't tend to do very well in recessions. They normally fall 25%, and I think the valuation side of it's already been baked in because those are expected now.
Changing the subject slightly. I was listening to another podcast over the weekend, and there was a strategist on there from an American bank who strongly believes that the Fed raising rates, cutting rates, has virtually no impact on inflation. What's his view would be you could have virtually left rates the same and inflation would have come down to where it is anyway.
In the recent 3-year period, I agree. It was all the supply chain tightness. I mean, maybe 20% was rates or something, but the vast majority of it was commodity price inflation, catch-up inflation. And once the central banks had printed all that money in COVID, that was what led to the inflation. They printed it, it got spent really quickly. That caused, demand to massively outweigh supply. So you saw prices go up for everything, used cars, houses, ketchup, whatever. Now wages. But it hasn't really done anything raising interest rates. Energy prices spiked partly because of Ukraine, partly because of supply side. So it is a monetary phenomenon. Milton Friedman, famous comment, over time, inflation is purely a monetary, always and everywhere a monetary phenomenon. But that's a long-term story. It's like saying the CAPE ratio will work. It will, but you might have to wait until 2033. But it still gives you a skew of symmetry, which I think is exciting enough to take the position. But it's not a quick game. It's a very patient game. And so over time, the higher rates are, the less likely you are to have high inflation. I think there is a correlation between those two things because it dampens demand. But you can't dampen demand. If I give you £100, then charge you £1 more a year for interest, you feel richer. And that's what COVID was. It doesn't matter if I charge you £5 more a year for interest, you still feel richer because you have the cash. And so until you've worn down and spent that money, what we called excess savings a year ago, it can't really have an impact. And the delay, the delay and variable lag is much more delayed this time round because of that stock of cash they printed before then tightening the price of money.
Yeah, and I think I've said before to clients, I mean, had you told me 2 years ago that rates were going from 0 to 5% within 15 months, I'd have said we'd have had enormous damage, both to financial markets and to the economy.
Yeah.
And I mean, yeah, sure. Like the Magnificent Seven, Amazon was down 50%, Tesla was down 70%, Netflix and Meta were down 75%. So you did have a lot of damage last year in large parts of the market. Government bonds in the UK were down 25%. I mean, where's that on your bingo card? But broadly speaking, there hasn't been huge problems, have there? The housing market hasn't. In fact, the house prices in the US are back at all-time highs.
Yeah.
I mean, it's extraordinary, really. Sort of sit with clients and say, well, it's not been a great 2 years. However, could have been a lot worse. Is there sort of element of if central banks cut rates a little bit next year, maybe not 125 basis points, maybe 0.5% or 1%, might they just get away without causing mayhem in markets and the economy?
Yeah.
Or is that sort of optimistic?
They might do. I mean, the bull case is that we have achieved a soft landing. Yeah, so we've had this.
That phrase.
No, but that's what you're talking about, right? That we've had the disinflation.
But so
we've still got employment at good levels.
We've already had a soft landing.
Well, we are.
Another cycle,
we're one
right?
wheel down on a soft landing, and we're just gliding down. Another 5 basis point cuts on a 500 basis points, but we're coming into the soft landing.
Aeroplanes for the children.
Yeah, exactly. My train. There's a steam train coming for this market. I'll try to sneak in as many as I can. No, it's that's the base case now. Not an outlier. That's what the market is assuming. I've literally just written my fact sheet. It says exactly this. It'll be in your inbox probably by the time you get back.
Oh, good.
But yeah, that's what we think. That the market is pricing in a soft landing as the base case, the highest probability event.
Yeah.
We think it is a very, very thin landing strip, and it's very unlikely to be good.
Yeah, well, I mean, as I said before we started, the theme of the pod has been episode 1. Do we think there's going to be a recession? Yes. Was that a year ago? Have we had a recession yet? No. So, but portfolios are up. We've done fine.
Yeah.
Valuations. I think my observation is valuations in large areas of financial markets look okay. When you talk about cash yielding 5%, short-dated government bonds yielding 4.5%.
Yep.
UK equities yielding 10%. UK small cap, take another love affair of this pod. Super cheap.
Yeah.
So I think that the long-term future is pretty bright, but there's clearly some kind of anomalies out there that we need to be slightly aware of.
Yeah, and even intra-market around the world. I mean, our global equity fund is made up of businesses you've mostly heard of that are $50 or $100 billion each, 12 times earnings, 19% average earnings growth for the last 7 years. They exist. They're there. They're trading. They're delivering. This year, we think our companies in aggregate will grow 17%. So they're delivering. It's just they're not getting rewarded right now. And that's what happens. If you take this approach, you can't hope to be rewarded every year. And that's the difficulty. And some clients may not like that as much. But over time, you can be much more confident in long-term outperformance because of the charts we've shown.
Yeah, good. Well, we need to get you out here, so that's probably time. Thank you, Freddie.
Not at all. Thank you.
Yeah, that was fantastic.
Thank you.
Really enjoyed you being on.
And thank you for joining us. Any questions or comments or anything you'd like to discuss, then get in touch. He's james.hughes, courseachievia.com. My email address is jonathan.raymond@courseachievia.com. And we hope to see you next time. Thanks very much.
Thank you.